We're talking about mortgage REITs and the difference between them and equity REITs coming up. Welcome back to the channel, guys. My name is Sean. If you're new here, I'm documenting my journey to financial freedom. If you're interested in talking about stocks and a little bit of personal finance, please consider subscribing. So I previously did a video on how to analyze a REIT, which a lot of you have found very useful. There was a little bit in there, or what I discovered anywhere, is there exist two kinds of REITs. One is an equity REIT, which is what we are typically used to. Those are the REITs that build and operate different buildings, residential, commercial, industrial. But I also came across these things called mREITs or mortgage REITs, and they're a slightly different animal. So I wanted to make a video that talked a little bit about those. So let's get into mREITs. We're going to talk about how they make money, the risks that mREITs kind of look out for, and then I'm going to go through the typical ratios that I look at for New Residential Inc. And I might touch on a few things to look for in the financial statement that I kind of found to be important. So let's get started. So the easiest way to really think about an mREIT or a mortgage REIT is that they're essentially like a bank. If you've ever got a mortgage or you have a mortgage, you'll really understand how these work. But essentially, mortgage REITs take money from shareholders, and their goal is to basically act like a bank. They lend it out to individuals or companies that are interested in doing real estate projects. That could be building new projects or investing in real estate. So they receive interest income on the money that they lend out. And really, they are just like how you and I might go to a bank and we want to borrow a certain sum of money, but we take out a mortgage at a certain interest rate, and that is the money that the bank makes off of us. mREITs can also make money off of mortgage-backed securities. The best way I can describe these is in the situation, again, starting with the bank. So sometimes banks want to make a little bit of cash. So what they will do is they'll bundle up a bunch of good mortgages and they will sell them to a mortgage REIT. What that means is these mortgages that they've lent out to their customers, they'll put together in a package into a security and give it to an mREIT, who will then take on that commitment. The mREIT pays the bank cash for those mortgages, and the bank can go off and do whatever it wants to do with the cash. So that way the mortgage REIT is left with these different types of mortgages for itself to commit to and manage. So the basic way to explain how a mortgage REIT makes money is, again, think of a mortgage broker. The mortgage broker will have a prime rate that is the prime rate that the federal government sets. Let's say it's about 1%, and you might go to the mortgage broker and get a mortgage of, let's say, 2.5%. So that 1.5% difference, that margin is what the mortgage REIT makes money off of. Just like equity REITs, they are obligated to give the lion's share of their money and their earnings back to shareholders as cash. The mREIT may have carry costs or administrative costs. Of course, they'll have to pay their people. So that all has to come out of that margin. Anything left over is fair game for the shareholders. So what are some of the risks that mortgage REITs kind of come with, or maybe situations that they would want to look out for? Well, I have 4 risks that I can think of or that I've read about, and I've grouped them into 2 groups of 2. So first, let's talk about interest rate risk and leverage risk. So what I mean by interest rate risk is the changing in interest rates, and that, let's say a mortgage REIT lends out to its customers at an interest rate of 4% and borrows at 2%, but now the borrowing rate starts to go up. Well, that will start to eat away at your margin and essentially take away from your profits. But that isn't to say that those environments are the only bad thing for mortgage REITs. Let's say that borrowing rates start to decline. Well, some customers might choose to refinance where they're at in light of these low interest rates, and that can also bring down the lending rate and the profits for the mortgage REIT. So what environment is better, high interest rates, low interest rates? I found articles that argued both, but essentially it comes down to whether the mortgage REIT and how the mortgage REIT manages those changes. And if they manage them appropriately, they should be able to make money in both scenarios, I would think. The one other risk that's related to interest rate risk is leverage risk. And what we mean by that is if the mortgage REIT has lent out money at a certain percentage for a long period of time, and all of a sudden interest rates really spike up and that borrowing rate is above the lending rate that the mortgage REIT has, well, that's not good. And what this will mean is that the income for the mREIT is actually negative, and that's really bad. You don't want that to happen. There are 2 other risks that are worth talking about. The first of those is the default risk. Default risk is really a default rate. And does the mortgage REIT know or can it predict how many of its customers are going to default on the money that they borrowed from the mortgage REIT. For residential and commercial, what I've been reading is that's about 9%. So 9% of the customers that it has may not be able to pay, or they'll default on their payments. The mortgage REIT needs to be able to cover for those. That means that they might put that into their interest rate and be able to cover off those that cannot pay and make sure it's still profitable. But it is something that they'll keep an eye on. And what they don't want is an economic environment that doesn't allow a lot of its customers to pay their rent or pay their mortgage, I should say. So that would be really bad for an mREIT. That is why you'll see in the charts that we get into, they aren't doing very good because a lot of commercial real estate has been struggling in the pandemic. And just like when we were talking about RioCan and Smart Centers, how they have customers who have closed doors and not been able to pay. It's the same kind of thing with mortgage REITs. People will defer or default on their mortgages. When they're not paying money, the mREIT's not making money, so that's not good for the mREIT. The final risk is similar to the default risk, and that's the origination risk. And this is a really dire situation where a customer defaults on the mortgage and essentially is evicted. When a customer is evicted, there is $0 coming in. That's bad for the customer and bad for the mREIT as well. I would argue that a mortgage REIT doesn't want the customer to be evicted. If they can get any money out of them, it's better than $0, but that is something that they'll have to be very careful about, and they don't want to be in economic environments or loan to customers that would be easily evicted or just wouldn't make the payments. It's not good for anybody. Now, the job of a mortgage REIT is essentially to manage those 4 risks, and if they can do that, they should be able to make money in most economic environments, but it really comes down to how do they manage their fixed and variable mortgages and the different products that they offer. If they're able to do that, there should be no issue for the mortgage REIT to make money and distribute the profits to shareholders. All right, now this is the part of the video where I kind of wanted to go in and do a bit of an analysis or look at some ratios for New Residential Investment Corporation. That is ticker symbol NRZ or Z. Now, I'll be honest, there's not a lot on the internet that walks you through how to do a real comprehensive analysis of a mortgage REIT. So I'm going to go through the ratios that I typically look at for a normal stock of a company, and I'm going to explain why some of those look a little bit different. Some of what you'll see is because these are mortgage REITs, but most of it is because of the current tough economic environment for these types of REITs right now. So let's jump into the spreadsheet. So these numbers are valid as of the 12th of October. The ticker symbol for New Residential is NRZ. The stock price is $8.38, dividend of $60. This is the trailing 12-month dividend. So it's worth noting that their dividend for the last quarter was cut and was cut pretty massively. It was pretty consistent at 20 cents for each quarter of the year. They've cut the last one down because, again, these REITs are not doing well. So 60 cents total over the last 12 months, yield of 7.16%. The cap of this company is 3.5 billion. And the earnings per share, you can see right there, is -2 cents this quarter. And that will kind of mess up some of the rest of these numbers. So your price to earnings ratio, which uses your earnings percentage, well, when it's negative, you're not going to get much of Yahoo. It's just going to say not applicable on Yahoo Finance. Same thing for your PEG ratio. One thing that's worth looking at is your operating margin, because this shows you how much money the REIT is making between how much it gets in interest and how much it's borrowing. Because of the negative income that is on its income statement, the operating margin is actually negative. It's just not doing well. Now, price to sales ratio is respectable, 2.34. Price to book ratio is also very attractive at under 1. And the current ratio also, pretty good there at 1.5. Free cash flow per share, this number is positive. And in case you're wondering why that is, it's because I could only get a trailing 12-month value. So over the last 12 months, yes, it has the free cash flow to pay its dividend. But if you were to isolate this to just this quarter, you'll see actually in the financial statement that it doesn't. Now, I also would have a section here to talk about payout ratio, but when you're paying out -2 cents to your shareholders, this section goes away as well. And the DGR streak I put here is 0 because, as I mentioned, they have had to cut their dividend very recently, so they don't have a long streak there either. Okay, there are some things that are worth paying attention to in this financial statement, so I'm going to go through that here just really quick. I jump right to the cash flows, and so right away you'll see here at the top that the net income is negative. However, you can look at the cash flows, and their cash flow from operations is positive, 2.766, what is that, billion, I suppose, because these are in thousands. If you scroll down, the cash flow from investing activities here is 16.3 at the bottom. And you continue down, you can kind of see some more net cash used by financing activities. Yes, that is negative. So there are parts of these that, you probably should dive into, but overall you want to see the cash flow statement be positive. So in general, for mortgage REITs, I think you really want to pay attention to the cash flow statements a little bit more than you might in other stocks, just because the nature of this type of company is a lot of cash coming in and cash coming out, and the difference of that is where you make your money. Now, the last page that's maybe I just want to highlight out of the statement is page 65, where it has the following table, which summarizes basic and diluted earnings per share. So here's where I was saying there is actually a negative number. But you can see from the net income minus the non-controlling interests and all the dividends, there is a negative net income here in 2020 for the last quarter. You divide that with all these outstanding shares, and you break it down per unit, you actually have negative 2 cents as your earnings per share. So not a good sign for investors, which is probably why the stock price is where it is now. But this isn't all doom and gloom. If you open up the presentation, the quarterly presentation to stakeholders, they are working on, or New Residential Investment Corp is working on what they call a comeback strategy, I believe. And they're taking steps in order to essentially rebuild and be profitable again, and basically navigate their way out of COVID. And they are successful in taking the steps to doing so. I think they will be recovering. If you go through that plan, which I will leave links to the financial statement and the plan and presentation in the description. If you go through that plan and you really dissect it and believe that it's going to happen, you might look at the price of this stock right now and consider it a bargain. And if you have the time to hold on to it, you could very well see this come back and make a little bit of good money on this. It's not uncommon for an mREIT to have negative EPS. If I look at the statement, you can even see in the same quarter in 2019, they were in a very similar situation with negative 8 cents. So it's really all about how these mREIT companies will manage themselves out of these quarters, and as long as they don't have this consistently happen quarter after quarter, they do seem to be able to continue to pay their dividends. Now, I'm going to have to be really honest with you guys and fully transparent. There is not a lot of information online on how to really do a good analysis of mortgage REITs, and that's why that last section is a little bit rough. That is the best I could kind of put together. I'm understanding the risks. I'm not sure, though, specifically in the financial statements, what is the best thing to look at. So if you guys are familiar with this, please leave some comments below, or if you have some good videos to reference me to. I'm totally open to a free education. I'm not going to pretend that I am the person who knows everything about mortgage REITs all of a sudden. That being said, if I were to follow my own principles, would I invest in a mortgage REIT right now, even though the prices are attractive? Well, obviously, I don't know 100% how these things work, and until I get very educated on it and very comfortable with it, that would be my reason to kind of hold off. But that's just me personally. If you guys, again, are familiar with this stuff, I am totally open to discussing it, and maybe it is a good time to invest in them. But one of my number one rules is not to invest in anything you don't really fully understand. And right now, I still need to get more education on mortgage REITs. So either way, I hope that this video has at least helped you understand the difference between equity REITs, mortgage REITs, and the risks involved in mortgage REITs. If it's provided you with some value, please remember to hit the like button, subscribe, and I hope to see you guys next week. So have a great week, spread the wealth, and we'll see you in the next one. Bye.